Joining us now, Wedgewood Partners CIO David Rolfe. David, good morning. Thanks for being with us. Both those names, though, they have held up relatively well amid the tech sell-off. Does this mean that you're sort of value hunting mode versus bargain hunting in some of the most beat-up names?
Yeah, absolutely. And some of the bigger, well-known companies that we typically invest in, they've come down enough. They have fundamentals that are actually accelerating. So, I mean, we're not overthinking it. We're trying not to chase some of these stocks that have been cut in half or down 70 or 80%, and all they have is maybe some revenues, and they may not even be growing. So the market is serving up some nice opportunities. It's nice to get the chance to swing a fat or bad.
Okay, the fintech space is certainly one where we've seen valuations come down. So your call on Visa, does that mean that you don't think that there's, an opportunity there, or are you seeing some of these names, whether they be in, a Robinhood, which we talked about earlier, which has fallen so much, or, buy now, pay later name that could be ripe for the picking right now?
Again, we're not going to overthink it. We've owned Visa for years. We've been buying it of late. It's one of our larger positions. And there was the narrative that, again, the stock was, go back a year or so, it was a little pricey, but this narrative that they were going to lose market share versus some of these startup fintech companies, I mean, it just wasn't the case. I mean, these companies are partners. They ride on Visa's rails, like Square and PayPal, Klarna, Coinbase, Stripe. I mean, they're all partners. And now that the world is opening up post-COVID, the all-important cross-border revenues were up 40% year over year in the quarter that Visa just reported. And here's a stock. It's 28 times this year's earnings, maybe 23, 24, 2023. Probably one of the most dominant business models in the world. So that's we've recently added there, and we're glad that we have.
Yeah, it's pretty interesting comments from all the legacy credit card companies this week about consumer activity, David. Although, so much attention being paid to just how much the Fed wants to tap on the brakes, and already signs of some caution at the household level. Do you just worry about that? I mean, not just for today's trade or next week's trade, but I'm talking the next several quarters, this sort of slow pressure on equities as we get into rate hikes and maybe QT.
Yeah, Carl, I'm really worried about it. In our last chat, I talked about this idea that the Fed is kind of in its own Hotel California. I think the new narrative, or not the new narrative, the new playbook, Carl, is that we have a generation, at least one generation of investors and traders who have never dealt with a Fed where they've probably taken away the Fed put or really lowered the strike price, and now they're going to be fighting inflation. It's a new playbook, and instead of buying the dips, we might be selling the rips. And again, the rips in a bear, I think we're in a bear market. The rips in a bear market are ferocious, and when they fail to make a new high, it's just a constant drumbeat. It's a whole nother psychology, and so we're going to do bargain hunting, but I think the Fed's in a tight spot, and they're going to go inflation first and Fed put, if it's even there, later.